Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Eric Johnson. Eric operates Shoreside Realty Finance, a lending company dedicated to working with both U.S. and foreign real estate investors. He is also an active investor in the Chicago market. So thanks so much for coming on, Eric.
Hey, Charles. I appreciate it, man. It's great to be here.
So please give us a little background on yourself prior to starting your current business.
Yeah, absolutely. So, it all started in 2015, and I was really pumped about getting into flipping. That was like my first, step into real estate, and it just really interested me at the time because just the entrepreneurial side of it, and hunting for deals and stuff like that. So that's really how I got started. I linked up with a couple of more experienced investors. At this time, I was actually living in LA. So, what a market to get started in, it's, and 2015, 2016 was just, it was just so hot. The deals were just flying off the shelf, and I'm talking like 12 offers on every property, like cash. And I'm not talking like hard money. I'm talking about families, that have trusts, and it's like money in the bank. And the fixtures in LA were at least $500,000, if not more. And that's on like the cheap end. So that's really how it started. I just kind of used that as a launch pad. I kind of got more we did some projects out there. It was great to participate in. I actually was kind of spearheading acquisitions for these more experienced investors, just because I wanted to learn, but I was kind of like all in on it. So we did a couple deals, some larger ones too, with not just cosmetic, but we did extensions. We added master suites to the properties. We did some ADUs and stuff like that. So it was a pretty good gamut and range of products that we did. But that's really how I got my start. And since then, flipping here and there, I've kind of drifted more away from that and kind of into rental, and really my primary focus is on financing. So but yeah, that's just a little background on how I got started.
Nice. So your company, Shoreside Realty Finance, offers financing for a number of different real estate asset types, and small, large, multifamily, commercial properties, bridge loans, fix and flip loans. I want to dig into a few of them and see what normal terms are available for both U.S. and foreign investors. So
Sure.
I imagine the majority of our listeners are going to be most interested in multifamily, whether that's small, residential 1 to 4, or commercial multifamily 5+ units. So can you kind of give us a little overview of what programs are really available for multifamily investors?
Sure. Yeah, this is a relatively complex topic with a lot of different moving parts. I mean, we could probably have a whole episode just on multifamily and talk literally about nothing else. So,
well, let's say from an investor standpoint, because obviously, if someone
Sure.
has 1 to 4 units, they're going to go like an FHA route, most likely, if they're going to live in one of them. But let's say for a investor that is already owned, is not going to be living in it, and
Sure.
it's going to be something that's completely, and we can go into agency stuff later on, but mainly the stuff that we would be, I guess, imagine going through banks and having it on their balance sheet.
Sure. Yeah. So, and again, even within the multifamily realm, so we're just going to stick to 5+ units right now. But even within that, you mentioned agency and non-agency, right? So I would like to go back and I guess unpack that. Agency, for those who are listening aren't sure, but just to kind of start from the beginning. Freddie and Fannie, the government sponsored entities who essentially purchase most of the loans on the secondary market in the U.S., also finance multifamily. So they, have their own programs for financing multifamily investments. And that's really the key difference, and that's what we mean by, non-agency and agency, right? And to kind of, I guess, dive into the context, agency has, Fannie and Freddie offer really good terms and really good deal structures for investors. However, uh, there's always a caveat, right? Is you have to check every one of their boxes, right?
Mhm.
Like, so just like, you would go to, for example, FHA or whatever. If you're doing just a small house hack, you have to check every one of FHA's boxes. But Fannie and Freddie on the apartment side are the same thing. They have liquidity and net worth requirements, right? So net worth has to equal loan amount. Properties usually have to be 90% occupied for at least 90 days. And Freddie Mac has a hard minimum loan amount of $1 million, and Fannie Mae 750,000. And it's, it's one of those things that if you don't have deals that fall within that realm, you can't really talk about them, right? So, but nonetheless, just to give people an overview, I mean, right now we're talking 75% LTV, even with COVID. They're traditionally 80%, right? I mean, they were 80% like all day, but with COVID, they dropped 5%, and they also require reserves. So that can be anywhere from 6 to 9 months of principal and interests. So you have to bring that to the closing table in addition to your down payment, and still have liquidity in the bank, left over. So it's like, it's not, you can't just knock on their door and get approved, because it has to be, one, a great asset, and then you really need to have your ducks in a row as a sponsor, right? So
Yeah.
that's kind of what I would say about agency to start.
What let's say now that's perfect. Thank you. What happens if someone can't uh they're not able to acquire that, let's say, for one or many reasons? Most likely it's an unstabilized property. And what are the options that someone has now, let's say for a 5+ multifamily that's over this loan
Sure.
amount 750, but they just can't get agency? Where would they go with that?
Right. So the next bucket would be conventional.
Hmm.
That would be the next bucket of money that I would choose from. Usually, you kind of just go down the list. You can go agency, conventional, CMBS. I mean, life insurance, if it's a bigger
Yeah.
deal, life insurance companies have, but they're more conservative, right? But so it just depends on the LTV that you need. But if you want a higher LTV and just less red tape, CMBS is going to be like definitely your next best route, just because of it's easier access to capital. They don't have as many overlays, in underwriting, and they're more operating statement based. So if you actually have a solid deal, you can maybe get away with some things on the sponsor end. If it's not, not all that solid, in terms of, maybe your experience or FICO score or something like that, where you need maybe a little more leeway, you're more likely to get that approval if you go CMBS. And just to clarify, CMBS stands for commercial mortgage-backed securities. So much like the residential side, which is MBS or mortgage-backed securities, where essentially there are pools of many loans separated into credit tiers and sold on the secondary market. It's the same thing, with essentially multifamily loans. So that's how this, I guess, loan product works. Very similar in comparison, but that would be the next best bet. And usually they do go lower loan amounts too.
Okay.
Probably talking down to 500K. Anything
Oh,
below
really?
500, that's going to be true small balance, right? That's going to be like non-agency small balance, and in which case, really you just have to find a a shop that does that kind of thing, because really, in order to make those kinds of loans, you need to have an investor who is willing to purchase those notes, right? So
Right. And when we're going in, how does that from conventional and let's say if you went to doing a bridge loan, and
sure.
is that going to go through a regular bank? Is that going to go through a separate lender? How does that usually work?
Yeah, so that's probably going to be just a private, debt fund or something
Mhm.
like that, which are, I mean, they're just direct lenders. That's pretty much all the direct lenders you see are, private debt funds. And bridge lending is something that as the term implies, it's to bridge the gap, right? Like if you have a non-performing asset, that's the very essence of using a bridge loan, right? Either it needs capex and rents are severely under market. Those are all, exact scenarios from which, you would use bridge financing, just because you need to get the asset to be, stabilized in order to even, think about putting permanent debt on it, in which case, when the property is stabilized, you can analyze, which credit or I guess which capital bucket, right? Which pool of money you want to pull from once you have the property to where it is. But ideally, you would have thought about that before you purchase the deal. So
What kind of terms is someone looking at for a bridge loan from a debt fund?
yeah, sure. So, bridge financing is very similar to like fix and flip, right? It's
Mm,
pretty much private capital. So, you're going to be anywhere from, 8 to 11%, 2 to 3 points origination, 18-month term, 12-month term, interest only.
mm,
So it's just, and usually they'll fund acquisition plus a portion of the rehab.
okay.
And if you have some good experience, it's not that hard to get 100%. So maybe you'll get 75 acquisition and 100% construction,
Yeah.
of the rehab. And depending on how you want to structure it, right, like that's what it will be. And it's pretty flexible.
Mm,
If you think you'll need a longer term, it's not, especially with multifamily, because they're bigger assets, right?
mm.
So sometimes it's really common to ask for 24-month interest only, need to get this property to where it is, and we'll refi after that, and that's the exit. The only thing we need to check on the bridge side, right, is to make sure that the area cap rates and the NOI give us the value that we need, right? And so when you refi, we need to make sure that all of that debt is taken out, and at that point, it's just a first, permanent first lien, either 5-10 year term, 25-year am, 30-year am, and from there just hold it.
Yeah, when I speak to some investors, I always tell them that the bridge lending is like the hard money lender of multifamily or commercial, where they're
Essentially, yeah. I mean,
yeah.
it's direct parallel to like fix and flip stuff. Like
Hmm.
even like the rates and the terms and stuff are very, very similar.
Okay.
It's just about the different execution, right? So
Mhm.
for multifamily bridge, we got to get a full appraisal, which for a multifamily building, is starting at a couple grand. And we need to comb through, that appraisal, make sure all the data is, what per underwriting guidelines. So but yeah, the bridge lending side, is it's less about the pricing and more about the execution, is like really what it boils down to.
Mhm.
Because it's all relatively going to be the same, unless you need like true hard money, at which point, you're going to be talking, they don't really care about you as a sponsor, like at all. It's really just about how they analyze the deal and where the asset is, because at that point, they're okay with, as long as you have the equity to come to the table
Yeah.
with down payment, closing costs, and they like the deal, they'll lend on it, because that's true hard money. But again, true hard money is going to be, double digit rates kind of
Yeah.
thing. Um,
So one of the things is I've looked at deals before that are unstabilized with partners, and we've seen some before that would be prime candidates for bridge lending. And
sure.
and then we've gone and actually worked with local banks on it. And I imagine every local bank or conventional lender is going to have a level of interest in different assets. So let's say,
Absolutely. Yeah.
so it's, you can find a similar asset, maybe get financing with maybe use both of them. Is that right? Or
Yeah, you know what? It really depends on your options,
Mhm.
at that point, because there are some local banks, maybe they have a portfolio fund
Mhm.
division of their bank, and they're like, let's do bridge debt, and some of them actually have approved programs for that, and but usually it is, it's very, very case by case. It really depends too, because a lot of local banks like local investors,
Right.
and,
Yeah.
and they only lend literally in their physical geographic footprint, right? So it's not like you can have one partner for all the deals that you're trying to do. Or, even if you do contact local banks, there's no guarantee that, they'll do, or they'll have bridge lending, right? And even then it might be more conservative than, going through like just a direct lender, for
Right.
example. So it
Now,
just depends.
yeah, I've seen that. It's amazing when I've spoken to local banks before doing, and how different what their risk profile is, what they like.
Yeah.
Because you'll speak to some banks, they don't want to do anything with multifamily, and then they only want to do something like certain asset classes, and then you'll speak to others, and they're like, we love doing multifamily, and we have these great deals for stuff that's within this radius of us. And it's very interesting if you contact a bank that's maybe not local to the area you're in, maybe it's even an hour or two away. They'll be like, oh, you can't find a bank in your area, why are you contacting us? And it's so
Yeah,
weird.
yeah.
It's like it's in the same state, but it's very interesting how it's very local.
Absolutely.
You're right.
They are hyper local on their stuff. Like even, just like you said, just like a couple miles outside their footprint, they're like, nope, we don't do it. Like, you get a hard no, or just specific asset classes. And that's what makes, I think, like navigating all of these
Yeah.
products just kind of overwhelming at one point, especially if you're trying to, if it's your first couple deals or something like that, and you don't have those established pathways, I
Mhm.
guess, that you can just kind of go off of from previous experience. So it definitely takes, a lot of research and commitment just to, line up the right option.
The one thing too, before we kind of open this up to other borrowers like foreign investors, but
For sure,
what
sure.
what I found with local banks as well is that it's much easier. The agency is kind of, this is what you get, and this is what it is. With local
Yeah.
banks, I kind of see it's like mark up the term sheet and send it back kind of thing with certain banks. Is that something common that you'll see with conventional lending, where what kind of leverage do people have on this when they say this is what we're offering, and they can kind of send it back to underwriting and say, listen, can we, modify this or that? Is that
Yeah.
something that happens normally?
Yeah, I mean, as far as deal terms and deal structure, I mean, everything is movable, right?
Hmm.
If you want to take off points on the front end and add them to the back as like a payoff, so you can defer and bring less cash to close because one of your investors pulled out, like just little structures like that, is definitely, I mean, especially in multifamily and commercial, it is business purpose lending, and those type of structures that fall maybe just outside of the guidelines. If it's a solid deal and the deal makes up for it, and you're solid as a sponsor, um, you can always make the ask. and
Hmm.
and no matter what, I always encourage, especially my clients, I present them with different deal structures, and you need to analyze which path to kind of go off of. And if something is like, oh, this option is really good, but like we're missing this, and I'll be like, well, we can make the ask for it, and
Yeah.
at that point it's open.
So what happens if with you have an investor that's foreign based that wants to invest in, let's say, U.S. multifamily, and they're working through someone like yourself? How does the deals differ, and in sense of how it's going to be structured, the requirements, what the lender wants to see from you, from the borrower?
Yeah, absolutely. So this is going to be more like a small balance scenario where really is operating statement based, right? As a foreign investor, there's personal income, et cetera, isn't, I mean, you really don't even have a FICO, right?
Hmm.
So it's like, how do you underwrite that? Well, it's pretty simple. They go to the lowest credit bracket of whatever that program is, and then that's kind of a placeholder, so to say, right? And since COVID and what I call the liquidity crisis, because that's really what happened, a bunch of investors pulled out funds on the secondary market, stopped buying notes from non-QM, and just different investor loans, and foreign nationals was probably one of the most, probably the most, one of the more heavier hit programs, just because it was like, okay, well, no one knew what was happening, and they all kind of literally within like 24 hours, everyone was like, yeah, we don't have that anymore. And, and I was still getting scenarios and it really, what it boils down to. But before COVID, I did some deals in Detroit, some multifamily stuff with some foreign nationals. They didn't have any US FICO. And essentially what, the requirements there were the DCR of the property, right? So for anyone listening, if you don't know what DCR is, it stands for debt coverage ratio. And that's really the main, I guess, underwriting factor in seeing how well a building actually covers its debt and how it pays for itself, essentially, right? Because that's the point of buying multifamily. And that can just be calculated by your gross income divided by PITI, or for multifamily, you need an NOI number, right?
Mhm.
So to divide by your P&I, and then that will give you your debt cover ratio. And then I can get into an example of that
Yeah, sure. Great. Please.
a little later. But yeah, just to finish up on the multifamily side, I mean, they were at a 10-year term, 30-year amortization, high sixes interest rate, no credit, operating statement based, building cash flowed, very well. It needed some repairs, but those were done before closing. We were able to clear those conditions and essentially just closed it, as is. And they took title, and as far as I know, that property is still going going strong, no issues there. But I will say insurance and loan costs are something that catch foreign nationals off guard,
Okay.
because yeah, especially these foreign nationals were from Canada specifically, but they only had Canadian credit. They didn't have anything US based, so we had to run them pretty much from zero. And they as Canadians, I know this from working with them and doing deals with them, their rates and their fees there are so low that they get in Canada, and they're so used to it, and it depends on your country, right, on where you're from. And so they come to the US and they're like, yeah, I want to buy this building, and they're I believe the points were I believe it was 2 or 2.5. And they're like, well, what are these? and I have to explain to them. And origination is just pretty much the cost of putting the loan on paper. And that's just a percentage of your loan amount. So I do want to make sure that especially foreign nationals are aware of US lending is more fee based, and I
Mhm.
feel that I'm having to just convey that point, or emphasize that more, just because people have questions on that. And then buying the multifamily building, getting insurance, the requirements, you have actual cash value versus replacement cost, right? And
Mhm.
depending on the lender you get, those two premiums can vary
Yeah.
drastically, right? So we got to a point where we had a replacement cost in place, and the vendor we had right now, the premium was just so out there, it actually like made the deal significantly worse.
Hmm.
And it almost killed the deal until we found another provider that had a much lower premium for replacement cost, so we were able to get that across the finish line. But that is something that is a very real issue.
Yeah, especially on older properties. That's where I found it. It can really differ.
Absolutely.
Yeah.
Absolutely.
The what kind of down payments or how do rates usually, is it usually a couple points higher? And I've usually heard like you're talking 5 to 10% more down and a couple points higher. Is that normally how it works for foreign investors?
Yeah, absolutely. So they were at 70 LTV.
Okay.
I was able to get them an exception for an additional 5%. I think based on their liquidity. So I was able to bump them up to 70. I don't think that's available right now.
Right.
And e- even in 1 to 4 units right now, I believe foreign nationals are capped around 60. I'm hoping that this will go
Mm.
up back to 65, 70 in Q1 of 2021, because things are starting to come back. But yeah, I mean, generally, if you're probably going to be at least 150 basis points, if not 200 basis points higher than someone with a US based credit, right? So if a US investor, you're going mid fives, you can expect to be at least mid sixes, right? So
Okay.
yeah,
Yeah.
something like that as a foreign investor.
Now, one more question too, in regards to, obviously they can partner with someone in the US and that kind of alleviates a lot of these issues. And I imagine they have to have just not like on a co-signer basis, it actually has to be a sizable owner in this entity that they're purchasing in.
Yeah, absolutely. So that would be an arrangement where you have, for example, you're more of a passive foreign investor, right? So you have a GP
Mm.
here, and you're, as a foreign investor, you're kind of behind the scenes. So
Okay.
what you need to find is, essentially that cohesion with a deal operator here in the US
Yeah.
that can take care of the quote unquote sponsorship side. Because as soon as you are as a foreign investor, you're a GP or something, and
Yeah.
rather than LP or a majority owner, then you need to send in
Yeah.
docs, right? And at that point it'll get dicey, and they'll be like, well,
Mhm.
there's one foreign national here, so we have to downgrade the whole program. So
Yeah.
you kind of want to stay hidden in that regard.
Yeah, and we have a lot of LP foreign investors, and it's pretty straightforward. The only, like you said, it gets dicey if someone wants to bring in a sizable amount, and they're, even if
Sure.
they're limited, they have to. I'm not sure what the number percentage is, maybe 10% of the deal or whatever it is, and they have to go through like a whole thing, like we're going through at the bank, where they check everything. Or if it's smaller than that, it's usually not a problem. And in my experiences of working with them, um, is that anything different than how you guys have worked with them before?
No, I mean, that's pretty, in alignment of what happens, just because it boils down to equity dilution, right? Of the
Mhm.
LLC, and the equity splits of how this thing is actually being structured. So, I would say that's very much in line. Yeah, if you want to put in a sizable chunk of change, you might want to, as a foreign investor, divide that chunk of change into
Mhm.
maybe multiple single asset entities with a different deal.
Yeah.
So, with your same target return. So at that point, you have the same cash outlay and hopefully the
Mhm.
same ROI, that you expect, but it's not diluting, just like it's not all in like one place.
Yeah. And you're not also under the microscope for dealing with any
Exactly.
of these underwriters, which will make
Y-
everybody in the deal. It'll be harder for everybody in the deal to get it done. So, um,
Exactly.
one question I hear all the time is purchasing in an LLC, changing terms of a loan. I mean, how does that work? If I, obviously, I think this is much more for a 1 to 4 unit question residential compared to
Sure.
5 plus. I've never had any type of issue purchasing or refinancing 5 plus with LLCs. How does that work? Does it really change a lot of stuff? Can you just kind of give us a little overview on that?
Yeah. So, I mean, you're right, and prefacing the 1 to 4 versus the 5 plus. That's definitely right, because yeah, the 1 to 4 where that really comes into play is uh, the consumer side, right? So
Mhm.
if you want to buy, 2 unit, 3 unit building, house hack it with FHA or something, you can't really buy in an LLC, right? And if you want to transfer it to the LLC, then all the investors get scared of the acceleration clause, and they're like, "Well, I know it's going to come due." And it's like that rarely happens. But what you could do is put it in like, like a land trust, and then
Yeah.
have the trust transferred to the LLC. But that is not legal advice, by the way.
Yeah.
But that definitely plays in the consumer side. So where I'm dealing, with is 1 to 4 units, but it's business purpose commercial loan on non-owner occupied investment properties, right? So that's the main determinant, because as soon as someone is occupying the property, it becomes essentially like a primary residence loan, which immediately falls under the Dodd-Frank act, and now all of a sudden all of those laws open up, right? Where this is more asset based for investors who they will never live in the property for a day, and that's the difference. And you can definitely purchase an LLC. In fact, we require it, just because it mitigates risk, and it's just, from a business standpoint, it's just a better thing to do. So you will only really run into that on the consumer side if you try to occupy the property. But on the asset based side, where we're just using just the rents, and the property, the cash flow of the property itself as the main underwriting, then that will be a non-issue.
Yeah. And anybody that's interested in doing that 1 to 4, definitely speak to an attorney and speak to someone that a lot of wholesalers do it and they call it subject to. and that's moving stuff from land trusts to other stuff, and they're taking over payments. So you have to find an attorney that actually understands it if you want to do that. But definitely check on it before
Absolutely.
you start filing paperwork and doing
Yep.
it, or buying the property in your name and hoping that you can do that. What are some of the most important factors of a real estate transaction that investors should be focused on when obtaining the financing? So like having the complete financials, or they should be focused on the credit score, or, I mean, what do you think is most important?
Yeah, no, I love this question because it really is just so if you want to qualify, the best step is to really reach out to someone and see what you wanted, and explain to them your scenario, right? So there's not really any magic formula other than, if don't have like a 580 FICO, but just have your strategy clear. Like, hey, I want to buy properties to fix, and then I want to refi, and I want to rent them out, and here's my market. That is information. If you have if you have clarity on your strategy, that is a phone call that we can have. That's something that we can dig into further. So now it's about the asset, right? I, just as you as you analyze deals, we need to make sure that the DCR of the properties you're looking at will in fact qualify, right? A good deal example, yeah, like just for a foreign investor, let's say, assuming 60% LTV, and let's assume the following numbers. We have a 130K purchase price on a single family, easily attainable in the Midwest somewhere, 1,050 a month in rent, 200 a month in taxes, 100 a month in insurance. And at 60% LTV on the 130 value, you're going to end up with about a $78,000 loan. And now your principal and interest monthly payment and a quarter interest rate with the 30-year amortization is $480.26. So if we add the principal, interest, and also taxes and insurance, we get a total PITI of 780.26. And so now all we have to do to get the DCR is divide the income by the total, right? So that's the 1,000 by the 780.26. We get our 1.4. So we know that the income covers our ITI, expense by at least 1.34. The common ratio, a common underwriting guideline is the property must have at least a 1.2, right? So if we don't have that margin, we can't really work with it in that capacity. But a deal like this would qualify.
Okay, awesome. Yeah, that was going to be my next question. What people like to see for the DSCR. So that's very helpful. What would you suggest to a new investor that wants to start preparing themselves for working with a lender?
Sure. So again, going back to clarity of the strategy, right? So just knowing exactly like what you want to do, investor, because I can help maybe tweak things. And in terms of, if you come to me and you tell me you want to flip, for example, then, maybe I can help you steer. But if you really don't know like what you want to do as an investor, that's definitely something you need to have down, and preferably maybe even a sample deal of some numbers that you can present, because the easiest way to get feedback is to just send me a deal with with the numbers, and that's something that I can analyze really quickly. I'll know if it works, and boom, you have feedback from an actual source firsthand, and you're not just saying, well, what if and this and that. And again, it comes down to really knowing your numbers, and get it from a primary source too, because you don't want to be overly optimistic and then put a deal under contract, find out your origination points or whatever to whoever you went to is 3 points higher than you thought, and this and that, and now the deal's like, well, then you don't know what to do and you're spinning your wheels, right? It's better to have all of that sorted, send a sample deal even if you don't have it under contract, say, hey, this is what I'm going to do, and then from there it's a much easier path forward.
Yeah, definitely. Anybody out there interested, building the relationships with your team are the most important thing in the beginning that you have to do. And it takes time to do it. It's not something you'll just do in an afternoon. So reaching out and having someone on the finance side and starting that relationship, even if you've never done a deal before, or if you have done a deal before, even if it's a fix and flip, you can put this together in a little PDF or something, or a Word doc, and send it off to potential people that you want to partner with or work with in your team, including a finance person, and let them know, this is what I've done, this is what I want to do. And then when you're actually sending over deals, review them, and not just sending over a broker's pro forma, and actually review
Thank
them.
you.
Yeah. I mean, you're supposed to be buying it and underwriting it, not Eric or the finance person. And they're just gonna put your email to the side, because it's not. If you send over, hey, this is the property, and then this is my underwriting, and this is like my assumptions, and it's not going to take them hours for looking at it, and they can look at it and be like, especially if they're if they're really knowledgeable about the area, they're going to say, yeah, this looks fine, or doesn't, and they can pass it forward, and it looks very professional. And then I would say the last thing I've seen before when I spoke to people is just having the correct terminology when you're talking to it. And it makes it so much when you're talking to someone and about the ratios, and it'll take you an hour reading it up online, and you can actually learn the terminology that he's using, DSCR, LTV, all these different ones that aren't very complicated, but just when you're using them, when talking to people, they understand that you're knowledgeable, you're educated, and you're going to be most likely less hassle when you're dealing with them, and you're actually going to probably close on the loan. So just a couple things, tidbits I've learned from doing this.
No, that's absolutely perfect, because right. If you don't know the terminologies, or you don't know how do you communicate what you want if you can't, and how do you tell, how do you ask the right questions too, right? That's a big thing in communicating, is how do you dig deeper if you don't know the surface level terminology.
Yeah.
Absolutely.
And Eric, one last thing before we close up, since you've been on both sides of the transaction, and I didn't know that you were so in depth with real estate investing prior to getting into financing. What are common mistakes you see investors make when they're purchasing? Actually, obviously, you've gone through a few things that people can do to prepare themselves, but have there been mistakes maybe before or after the closing that you might want to share? I imagine you've heard it, horror stories and grand slams. So.
Yeah, absolutely. No, I mean, just from my own experience. So, flipping houses that are too large. So that's one. So if you want to, don't take down like a 2,200 square foot 5.4 house, even if the number is pencil, because like your costs are going to be like triple. You might think, oh, well, it'd be like double or like times, and no. Like, your labor is going to skyrocket. And then, that's not even factoring in, the additional contingency, greater than 10% that you should have for something like that. So that's probably my first thing, is any flippers do like small projects, like cap it at plain vanilla houses, American houses, which is, 3.2, 2.1s, 1,400 square feet, like really just simple stuff. And, on the finance side, if you have a deal where you're flipping it and then you want to rent it out, and it requires essentially 2 stages, right? So you have the first stage, which is your acquisition, and you have your construction, and then you have your finance exit, and then you have, obviously just renting it. You want to make sure that you have the forethought to put both of those pieces in place. I've seen that mistake where investors come to me in a jam, and they're like, hey, I thought I could refi this, and this like is not working out. I'm like, wow, like, you need to make sure that option is there, no matter what, right? And if you want to go conventional, and it doesn't matter what route you want, right? If you want to go asset based, if you want to go conventional, either way, you need to have that person in your corner before you even put the contract to purchase, in, and that's it's so critical, because it leads, that's probably like 30% of all the jams that I get are just, hey, I can't refi this and the loan is due. What do I do?
Yeah. Yeah. That's crazy. I mean, that's something that you definitely have to look forward to, and knowing that, if you were buying something earlier in 2020 and then COVID hit and you're trying to refinance it, obviously, if there's not secondary markets for the people you're trying to get loans from, they're not going to have money to loan to you.
Exactly. It's a great lesson in essentially liquidity, and how conservative things can get literally overnight, right? Because I mean, people were 80% LTV, all day, 70% foreign nationals all day, and all of that just got cut by at least 10% overnight. And that's, 10% is a sizable number, could, easily put a dent in your ability to pay off a loan that's coming due, especially if you have a 5-year, balloon on a multifamily, or a 10-year, and that's like right at the cusp. You probably just have to go back to your bank and get an extension.
Yeah.
Which
goes back to your relationship with your lender and how important it is when you're going through it. And
Exactly.
Because they're the ones that are going to say, yeah, we'll just, we can push this out, or they're the ones that are going to be a little bit more aggressive, which is not going to be good for your whole business plan. Eric, so how can people learn more about you and your business?
Yeah. So my website is shoresidefinance.com. And my email is Eric, ERIC, at shoresidefinance.com. So, anyone who's, on the fence about getting started, or, they have cash, and, they're looking to put it into an investment, and it sounds like something I can help with, you're more than welcome to reach out to me, with an email, and I'm happy to talk. And I also just released my own podcast called House Hacks for Flipping Stacks. So hopefully by the time that this is live, that's something anyone who's listening can check out as well. And that'll have, and if you like what you heard here on the financing topics, then there'll definitely be a lot more of that on my show as well. So
awesome. Okay, Eric. Yeah, send me out those links. I'll put them in the show notes as well. And I want to thank you so much for being on today.
Awesome. Yeah. Thank you very much, Charles. Appreciate your time, man.
Have a great day.
Okay. You too.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars Incorporated exclusively.